Good afternoon and welcome to this recorded presentation of the remarks that I made in our True Blue Partners Investor Conference not too long ago last weekend. Since this time, we had not broadcasted hybrid. I wanted to make sure our investors outside the Bay Area were able to get some of the information in a recorded format. And also I get to test out some new gear that I have in my home office. So first of all, let's start with the financial markets. What are the markets doing and where are they going to go? Let's look at the data, and I think the conclusions are going to be fairly obvious, but everyone's got their own take on it. And I'll talk about why looking at the financial markets is important for all forms of investing, because it influences the money supply in our downstream investments, etc. So on this graph, what you see on the x-axis is a time monthly. On the y-axis is the inflation rate. The secondary y-axis is the Nasdaq, and this blue line here, this is when Russian special military operations. And even though you'd see in the blue bar is the actual inflation rate, and this is the CPI, the Consumer Price Index, or the what they call as the headline inflation rate, includes food and energy. So it's more volatile, and it's one of the many things that the Federal Reserve looks at to decide interest rates, and interest rates decide money supply. Money supply, decides capital availability, and interest rates decides valuations. And so anyway, this is the overview of the first graph. There are a few graphs here, and I want to look at it in a together format to say, where are we in this money flow cycle? This chart talks about the core PCE, the personal consumption expenditure. It's a key driver of Fed rates. Prices go up, consumer spending goes down, but PCE captures the net. So if things go more expensive, people either consume less or they switch to other substitute products, and this is almost like a weighted average of the demand and the price, really driving an indicator of economic activity. And the third one is, what are the interest rates? This is where the interest rates were, and this is what's forecasted for the future. So let's look at them together. What was going on in January and February? You can see the interest rates at 1.4 to 1.7%. That's as healthy as it gets. There was some sense of, inflation is kicking in because there was a lot of monetary stimulus in the COVID time period. There was also a lot of uncertainty as to how things are going to shape out in this post-COVID economy. When is COVID going to get cleared out, etc. And so, the interest rates were very, very low. Those were driven low. And if you remember the way the Fed had responded to COVID, and I think this chart captures this, again, is enterprise value revenue multiples for the SaaS. This is the Fed's fund rate. This here, blue line, is the Nasdaq total enterprise value by revenue. So really the revenue multiple, and you see it varies from 3 to 4 to 3 to 4. And then this is the SaaS index multiple. So this is and there's a lot more data around that, but we track all publicly traded SaaS companies, very closely to see what kind of impact is happening on the valuations. And so here in this chart, we track it in the form of a index. And you can see the index goes from 13 to 6 in this time frame. But the interest rates, when COVID hit, and this symbolizes when COVID hit, the interest rates were dropped very, very rapidly. And then the market, after tanking because of the COVID lockdown, started recovering. And then once the interest rates remain low, and there was a lot of stimulus money on top of that. So this is the monetary money, a monetary policy, and the fiscal policies, the stimulus tax credits and infrastructure spending, etc. And so that led to a bubble in the valuations on the SaaS index, which is really what we track. And you can see once there was an anticipation that the interest rates are going to go up, and Fed does a pretty good job of broadcasting that, that's when your valuations and the market indices started dropping down. So let's look at that, one more time. Here, inflation has started going up. This is the headline inflation. If you guys remember, there was this whole talk about, transitory and, no need to do anything, no need to increase interest rates. Things are humming on fine. Market is heating up, but this is supply chain blockups and, all those other factors that could be there. But that was not the case. The economy was heating and it overheated. And, the headline inflation number spiked, which probably, was one of the factors why the Fed decided, okay, it's time to start increasing the interest rates, because once you get into that 10% CPI inflation rate numbers, that gets pretty scary. So yeah, that's basically it. So now the question is, where are we now and where are things going? You can see, a lot of chatter about headline inflation going down. The PCE is still pretty flat, but then if you look at it, a little bit more closely, since September, it has been slightly on the down and down. It really hasn't jumped up too much, and that's a good sign. And so, as you can see, correspondingly, since Feb, the Fed really has not been as aggressive on increasing interest rates. It's not expected that they're going to increase interest rates, red remaining the forecast. And then, sometime in Q1 next year, there's actually some forecast that the interest rates might come down. Now, 1 week later, since we made this presentation, I think if you look at the comments that the Fed Reserve Chairman Powell made yesterday, I think the speculation on Wall Street Journal is, I think they're done with their interest rate hikes. Nobody knows when it's going to start coming down, but the best guess is Q1 next year. So now, how does all of that translate into what we do in early stage investing here at TrueBlue Partners? Well, we've got to look at valuations, because eventually the ways in which we take your investment dollars and try to get you above market returns is we've got 4 levers. One is get in there early, write smaller checks, get a valuation advantage, participate and contribute to the growth of the company, get it to a level where the size of the business is a little bit higher, get a valuation bump plus the growth of the business bump, and then exit it at an attractive valuation. Given the work we've done historically in the investment banking space, we think we understand the nuances and the metrics that drive value, the financial metrics that drive value in a business. But those come into play a little bit later. Let's take a look then at the valuation multiples, and let's take a look at a few takeaways. So this is again now looking at the across all sectors, looking at the valuations for SaaS companies, and if you subscribe to the notion, I hope you do, and that's why you're part of this fund. If you subscribe to the notion that software and now AI assisted software is going to eat up the world, then by investing in software companies which provide the software to multiple verticals, you are achieving your diversification goals. And here there are different kind of software companies: CRM, ERP, data analytics, industry vertical focus. But even if you're an HCM software company, you're selling to companies across all verticals. And then what we see here in the communications verticals, and these are companies like Five9 and other contact center companies, Zoom, Cisco, etc. What we see here is that this blue chart is the end of year 2020 median enterprise value by LTM revenues multiple. Everything in SaaS today trades on a revenue multiple as a forward indicator of profits. And what you see is there was an anticipated heavy growth in 2020 when COVID and work from home hit. So that growth did materialize. So you can imagine 40 times revenue means if the revenue is double the next year, it's 20 times revenue, and that came down. Sorry, 28 times revenue is once the revenue doubles, the valuation multiples come down. But now, because the valuation multiples were that high and the revenues did increase, and the same level of growths are not anticipated, there's been some pullback, and the valuation multiples for companies in the communication vertical are particularly hard hit. On this graph, we look at enterprise value by the revenue multiples by enterprise value, and the takeaway is the larger you are, the more valuation multiples you get. They are safer assets, they're more predictable, more reliable, and in times of market pullback, they preserve value a lot better. And so you can see while across the board, they've always been, if you compare year over year, so if you look at this blue bar and you compare it to this blue bar and this blue bar and this blue bar, year over year, every year, the larger enterprise values companies get valued larger. Now, whether it's because they have a higher valuation, therefore they become larger enterprise value, is there a closed loop? And we kind of dissected that out. That's not the case. This is true across the board. The larger you are, the more resources you have, the more market size you're targeting, the better the multiples you end up getting. And so let's look at gross margins being a proxy of cash flows. Higher gross margins, higher multiples, and growth rates, higher growth rates, higher multiples. And that's while all the multiples have gone down, that's true most years, except in this year, the higher growth rates are not getting a premium to the reliable, predictable growth rates because of the changes in the market. So we looked at these data, look at this data carefully to kind of keep a pulse at the market, and it boils down to why AI in the enterprise. We've looked at that, but never hurts to do a recap. This is the presentation that we made in 2021 when we had made the bold idea that hey, AI is going to change the way enterprise software is built, and all enterprise software will have AI today. That's not such a novel idea. ChatGPT has really accelerated the time to market that we will see, and keeps us in a fairly good position. So we focus on the enterprise tech market. And just to quickly recap, this is where we play. We come in when the companies are in that product market fit determining you could call it they have a product market fit because they have 100K, or they're still kind of iterating on their go-to-market, and we help them build out what would be the right pricing, packaging, channels, etc., to launch and invest in downstream go-to-market initiatives. And so that's where this comes in. And then afterwards, you got to manage growth. So our benchmarks where TVP Venture Fund 1 plays is in that starting at that 100K ARR. And if it's a proven entrepreneur, we can overlook that because they, some of them know what they're doing, and those are the ones we back. And then work with them and help them get to that 1 to 2 million ARR, and really start measuring once they go from the 1 million to 2 million ARR, start looking at other parameters like growth rate. And so now, looking at what public market multiples for growth rate are, and 20 to 30% is not the kind of growth rates we have in that 1 to 2 million ARR range. It's a 2x, 3x type growth rates, so significantly higher, but really keeping a barometer of what kind of revenue multiples are we operating at in terms of our earlier investments, etc. We're looking at from an enterprise value perspective and creating that value. This is what our portfolio looks like at the infrastructure layer, at the admin productivity tools layer, at the CRM, human capital management, and then some companies like Highway Hall and CopyLeaks being very industry vertical focused. CopyLeaks is the one company that's having breakout success this year. largely because of ChatGPT. And what they do is they're a plagiarism detection software. This is the one company that even my high school kids are able to recognize the name and actually find a little joy in the fact that our fund has invested in it. Share that if you have kids in high school, ask them if they know about copy leak. If not, they should get to know about copy leaks. Um, and so when you look at that, why do we look at public markets that closely? Because it predicts the not only does it predict the future cash flow, it's also a diversification strategy. I mean, when the valuations in the public market were higher, our strategy was to take money out from the public market and put that to work in private markets where you have higher hold periods. And then, right now when the valuations in the public market are fairly low, we focused on just follow-on investments on companies that are getting that product market fit and some, breakout successes. We did exit our investment in Docket. It got acquired by Zoom. I think that in retrospect was a smart move because the growth in that whole space is not taking off the way that it was in the earlier days of adoption. And you can see we've been very prolific when the valuations were high in making our initial bets or initial investments. Now, remember, we are very early in the investment cycle. And so the talent that comes to market when the valuations are higher is actually better from the founder's perspective. And that's why, I think we have a pretty good portfolio of companies. Now, we don't think everyone's going to make it. We just don't know which one is not going to make it today because we have that 2-year hold period where they are figuring out their product market fit and their go-to-market strategies. We are now back, aggressively looking to make new investments in the next 6 months. But in the last several months, we've focused on our portfolio and helped them get stronger. Now, to put it in context, the first investment that we made out of the fund, it was made earlier, but was rolled into the fund, is Vector Flow. That was made in Q1 2019. It's got, a 4 to 5 year gestation period already in there. These companies are all invested much later in 21. So it's almost a 2-year, lag, but then I think there's a tough market right now as well. But it's all about managing risk, and to manage our risk, we do have a portfolio approach. We don't invest in a portfolio of companies. We invest in individual companies and focus on each company standing on its own to return our investment dollars. But we get diversification through building out a portfolio. That's a portfolio strategy. I've reviewed that in the past, and we're currently around 9 to 10 million of capital deployed out of a $25 million capital deployment strategy. Just to recap, as an individual investor, you want to put aside the funds that you're targeting venture capital type returns, long holding periods, 20 to 30% compounding IRR over a long period is a very high return. But what it tells you is you need to be patient, and one of the things that we've said then is and we'll say it now, these are illiquid investments. Our investment thesis is to be with these companies as long as they want to. We don't have a hey, we want to come in and out in 3 years or 5 years type strategy, and that's usually driven by the very large institutional LPs who need the cash back, either put it to work somewhere else or for their cash flow purposes like pension and things like those. This is a group of LPs that are all individual investors, and so much more flexible. And that's our request to our LPs, to be flexible and give us only the capital that they will not need, for their foreseeable future. But at the same time, don't want it just making 8% returns. They wanted to make more than 8% returns. And so our fund journey is about company building and doing that in repeatable and predictable ways. So towards that, we are about to launch a company building series for entrepreneurs in B2B, SaaS, and AI. We've got the building blocks and chapters, and the format's going to be basic concepts, hopefully covered in a format. In this format, it's a video and some reference materials, followed by some case studies and panel discussions around that, and then Q&A, both online and offline Q&A. It's about the company you keep. We've been a long-time partner since the days of inceptions in 2018 with IIT startups, and by no means are we of the size and scale as a venture fund like Canon or Lightspeed, and we hold them in very high regard in similar spaces, but we do share the institutional sponsorship position with them at IIT Startups, and IIT Startups Bay Area does participate in a lot of these very prominent leadership conferences, and what better a person to have as the keynote speaker this year on September 16, 23 than Mr. Wang from NVIDIA, which is kind of the forefront of driving the AI revolution. We've also been invited by University of Chicago Polsky Center's Transform Data Science and AI Accelerator, which is a combination of University of Chicago, Chicago Booth's Polsky Center, and then University of Chicago Data Science Institute. It's an incubation and accelerator format, and it's really a networking avenue, and not necessarily the companies that graduate from these cohorts, but the network and the sourcing of deals and talent that comes from incubators and ecosystem like this is extremely helpful. And this is not easy. Don't try this at home. I mean, the investing principles of Warren Buffett hold true in the company building phase. Buy only something that you're perfectly happy if the market shut down for 10 years. And that's advice for publicly traded companies. Our thesis in the private space is there is no public market for these companies for the next 10 years, but either they'll get acquired or they'll go IPO sometime shortly thereafter. There's a fairly liquid secondary market for good companies, and as needed, we'll tap into that. Never invest in a business you don't understand, and I think we understand the enterprise software business largely because of the work we've done in that space, and also because of the cohort of LPs that we have who've been in this company building space themselves. It's good to learn from your mistakes and better to learn from other people's mistakes. And look, we've done our mistakes in the past, but we've also had some super hits in terms of the kind of returns that they've generated. We've been in the investment banking business where even though we got paid when a transaction happened, we were never transactional in our service offerings. OSF was something that we invested in. Process Weaver was something that we invested in Quero, the engagement was over a 3-year period. AST, the engagement was over a 4-year period, and so on and so forth. We've been in the company building business for quite some time. And then many of our pre-fund investments have given us the foundations that give us the reference point to put together a company building curriculum and see how these companies that we are investing in are falling in the spectrum of growth cycles and company building cycles, and where they need help. But not only that, as a merchant bank, True Blue Partners has invested in other funds as well, private equity and venture capital funds, Acadian and Emergent being early stage venture capital funds, Delta V being a growth stage fund focused entirely on enterprise software, and NextGen being focused on recapitalization of businesses, both B2B and but really business to business services being a focus area, but not necessarily all software, and smaller companies like in that $1 to $5 million of EBITDA range. And Delta V comes in, at around 10 million ARR, all the way to hundreds of millions of dollars. And so that's the other thing that we do is we manage our time of engagement. So P referred to being passive and A being active, and we've made money in our previous pre-fund investments, both in a passive as well as an active format. In the portfolio, we usually start active, and then once things are on cruise control, we move into passive. And in some companies, where other VCs are leading the work, like Copy Leaks or Data Pelago, we've had a passive role. Aerodate is going to announce something major, and that's going to make our role change from active to passive. And in other places where certain milestones are being met, our role might change from passive to more active. And so we did have a discussion on HCM and HR tech, given our portfolio has several companies in that space. But that's broadly the prepared materials. And I think if you want a copy of this presentation, I can have that available for you through our portal. And thank you very much for listening through this. And if you have any questions, you know how to reach me.